Hello, and welcome back to Forex School from Pip Insight. Today we're tackling one of the most requested subjects on this channel, supply and demand, the study of where the market's resting orders live, and why the place's price once launched from keep pulling it back. Here's the roadmap. We'll start by upgrading an old habit, why a level is really an area, not a line. Then we'll watch zones being born, the quiet base before an explosive departure, and learn to mark them properly, using the candle bodies rather than the wicks. We'll compare fresh zones with tired ones, put zones together with trend, and walk a complete worked example from first candle to last. And because this is Forex School, we'll finish with the honest chapter, when zones fail, and what's really behind them. Everything in this course is education, not financial advice. Notebook out, let's begin. Think back to the support and resistance course. We drew lines, and lines are a brilliant first step. But watch any level closely and you'll notice something awkward. Price almost never turns at exactly the same pip twice. One bounce ends for pips early, the next overshoots by 6. That isn't the level failing, it's the truth of how markets fill orders. Buyers don't queue at a single price, their interest is smeared across a band of prices, placed by thousands of participants who each picked a slightly different number. A line pretends the market is precise. A zone accepts that it isn't, and captures the whole cluster of turning points inside one honest rectangle. Let's prove it. This market falls hard and finds buyers at the first candle marked low, the wick stops at 127.04. A trader draws a line there and waits. Price rallies, rolls over, and comes back, but the second marked low dips to 126.96, 8 pips through the line, before bouncing hard. The line trader was run straight over. The third visit turns at 127.08, for pips before the line. This time the line trader missed the turn entirely. Now watch the zone sweep in, a band from roughly 126.94 up to 127.12. All three turning points live comfortably inside it. Same market, same buyers, but only the area told the truth. Now for the heart of the course, how a zone is actually born, the quiet base before the explosive departure. Every meaningful zone has the same biography, and it comes in two flavors. Picture a falling market that suddenly stops and goes quiet, 2 or 3 small candles, going nowhere. That pause is the base, the place where selling pressure met something big enough to absorb it. Then comes the departure, an explosive move away, far too fast to be casual. When the market drops, bases, then rallies, that base becomes a demand zone, a shelf of unspent buying. When it rallies, bases, then drops, the base becomes a supply zone. In plain English, the base is where the business was done, and the departure is the receipt. The bigger and faster the departure, the more seriously traders using this framework treat the base it launched from. Here's a demand zone being born. For heavy candles fall from 127.82 down to a low of 126.94. Then everything changes character, 3 tiny candles, bodies packed between 127 exactly and 127.08, drifting sideways. That's the base, selling pressure meeting patient buying. Then, the departure, a single powerful candle closing at 127.44, and 2 candles later the market has touched 127.92. Nothing about the base predicted that, the departure is what reveals it mattered. The zone sweeps in across those base bodies, and notice how it extends to the right, because the story isn't over. Price is already sagging back towards it, and what happens on that first return is a later chapter's subject. Now the mirror image. This market climbs for 4 solid candles, from 128.18 up towards 129. Then the pause, 2 small-bodied candles stalling just under the high at 129.10, bodies packed between 128.92 and 129 exactly. Rally, base, and there's the drop, a heavy candle closing at 128.56, then another, and within 3 candles the market has slumped to 128.04. That base is now a supply zone. Watch the recovery, price climbs back for 3 candles, and the bar-marked retest spikes to 128.98, inside the zone, then closes all the way back at 128.52. Rejection. The next candle falls to 128.18. The first return met exactly what the theory says was left behind. So how wide should a zone be? Here's the rule this course recommends: draw it across the bodies of the base candles, not the full stretch of their wicks. Why? Because a candle body shows where the market accepted price, where real business settled. A wick shows a moment of panic that was instantly rejected. Build your zone from wick to wick, and one dramatic spike can double its size, turning a precise area into a blunt one that tells you almost nothing. Keep the box tight to the bodies and you get a zone that says something specific. This is where the orders actually changed hands. Wicks are information, bodies are evidence. Here's why it matters. The market steps down into a base, and look at the middle base candle. Its wick spikes all the way down to 126.04, but its body, like its neighbors, sits packed between 126.34 and 126.44. The departure confirms the zone, running up beyond 127.20. Now the choice. A wick-to-wick zone would stretch 40 pips deep, all the way to that spike low. The body zone is the tight band drawn here. Watch the return, price sinks, and the candle marked retest dips to 126.32, kisses the lower edge of the body zone, turns, and closes back at 126.40. The rally that follows never goes near the wick. A trader anchored to that spike was still waiting, nearly 30 pips below, while the turn happened without them. A zone is not a battery that recharges, it's a larder that empties. The theory runs like this: a base marks where large resting orders were left behind, and the departure proves they were real. But every time price returns, some of those orders are filled, consumed, and they do not come back. That's why the first touch of a fresh zone is treated as the strongest. The larder is full. By the second and third visit the reaction tends to weaken, the bounces get shallower, until one day price arrives and finds nothing there at all. Traders using this framework grade every zone by how many times it has been hit, and fresh means untouched. Back to our demand zone from earlier, the base with bodies between 127 exactly and 127.08, and the departure that flew to 127.92. Now the part we skipped. Price rolls over at 127.92 and sinks for 3 candles. The third, marked retest, dips to 127.04, dead inside the zone, on its very first return. Watch the response. The candle closes back at 127.12, and the very next one surges to close at 127.48. No hesitation, no grinding sideways, a full larder. That is what a fresh zone holding looks like: a one touch, an immediate turn, and the move resumes in the direction of the original departure. Now the sad version. A demand zone forms, drop, tight base, then a departure that runs to 128.62. First return, price falls back, touches the zone, and bounces to 128.52. Decent, but notice it couldn't reach the old high. Second return, another touch, and this time the bounce dies at 128.36. Third return, the bounce barely manages 128.20. Look at that sequence of shrinking rallies: 62, 52, 36, 20. The larder is emptying in plain sight. Then the fourth arrival, no bounce at all. The candle marked BOS slices straight through the floor and closes at 127.84, and the next one keeps falling. Each touch consumed orders. The break was simply the receipt for an empty zone. Not all zones are equal, and the biggest separator is trend. Think back to the trend structure course. An uptrend is a staircase of higher highs and higher lows. Now overlay this course on that one. A demand zone that forms during an uptrend is a with-trend zone. The pullback into it is exactly where the next higher low wants to be born. A supply zone inside that same uptrend is fighting the current, and it gets steamrolled far more often than social media screenshots admit. So traders using this framework filter ruthlessly: demand zones in uptrends, supply zones in downtrends, and counter-trend zones treated as warnings on the map rather than invitations. Here's alignment on a chart. 3 rising candles print a swing high at 130.18, the candle marked HH. The pullback that follows is orderly, and it ends in a shape you now recognize instantly, a tight 2-candle base under 129.62. Drop, base, and there's the rally, a departure candle closing at 130.04, then a push that closes at 130.26, clean through the old high. That's the candle marked BOS, a break of structure, proof the uptrend is alive and well. So look at what we're holding, an uptrend, a fresh demand zone, and a base that is itself the newest higher low. Every course on this channel is pointing at the same rectangle. That's confluence, and the worked example will now walk it to its conclusion. Time to put the whole course on one chart, a complete worked example, from empty screen to conclusion. Everything that follows is a constructed illustration for education, not a live trade, and not a recommendation. Read the chart the way this course taught you. First, trend, the climb to 130.18 says buyers are in charge. Second, the base, 2 small candles, bodies packed between 129.50 and 129.62, resting after an orderly pullback. Third, the departure, a drive that closes at 130.04, then a close at 130.26 through the old high, the marked BOS. The zone is drawn across the bodies, fresh, untouched, and sitting at the newest higher low. Then, the weight. Price sinks for 3 candles, and the bar marked retest dips to 129.50, the zone's lower edge, first touch. The response, a close at 129.90, then a surge to 130.34. Fresh zone, with the trend, first touch, every box this course owns, ticked in order. 3 lessons worth keeping from that chart. First, the zone was identified before the return, the base, the departure, and the break of structure were all visible in advance, so the area of interest, and the point where the idea would have been wrong, both existed before the touch. Had price closed below the base, the story was simply over. Second, patience carried the whole setup, the reward arrived on the retest, several candles after the departure had everyone else excited. Third, and be honest with yourself about this, constructed examples are clean by design. Live charts will hand you overlapping bases, ragged departures, and ambiguous touches, and very often the correct decision is no decision at all. Now the part most channels skip, when supply and demand fails, and what's really going on underneath. A zone is a memory of orders left at a past turning point, and memories can be overwritten. The most reliable eraser is news. When an NFP print shocks, a CPI number surprises, or a central bank shifts its stance, the market isn't consulting last week's base, it is repricing the entire currency in seconds. Fresh zones, perfect zones, with trend zones, all of them get sliced through as if they were never there because the orders that built them belong to a world that no longer exists. Traders using this framework respect the calendar, they know which days belong to the zones, and which days belong to the headlines. No rectangle survives a repricing it wasn't drawn for. Finally, the narrative itself deserves scrutiny. The popular version says every base is a footprint of institutional orders, banks quietly building positions, then defending them on the return. It's a compelling story, and it cannot be verified, nobody looking at candles can see whose orders they were, and no published research confirms that bases are institutional at all. Here's the simpler explanation, and it needs no mythology, prior turning points attract unfinished business. Traders who miss the move want in at the origin, traders trapped on the wrong side want out at break-even, stops and pending orders cluster wherever something visible happened. All of that is quite enough to make price react at old bases, no secret smart money required. Keep the pattern, hold the story lightly. Let's fold the whole course into one page. A level is really an area, because order flow is smeared, not surgical, so we draw zones, not lines. Zones are born as a base before a departure, drop, base, rally leaves demand behind, rally, base, drop leaves supply, and the violence of the departure is the evidence that the base mattered. Mark the zone across the base candle's bodies, because bodies show accepted business while wicks show rejected panic. Grade zones by freshness, the first touch is strongest, every test consumes orders, and exhausted zones break without a fight. Align zones with the trend, so pullbacks into demand become new higher lows. And stay humble, news erases zones without apology, and the institutional story is optional. Unfinished business at prior turning points explains the pattern just as well. And that completes the supply and demand course. You can now look at any chart and do things most traders never learn: spot a base before a departure, draw the zone across the bodies, judge whether it's fresh or spent, and decide whether the trend is behind it or against it. Practice exactly that this week. Mark 10 zones on old charts, then check, honestly, how each first touch behaved. If this course earned it, subscribe and ring the bell, because the next course builds these tools into a complete trading plan. And the words we close with every time: everything in this series is education, not financial advice. No method is a promise of profit, and trading carries a real risk of loss, so practice on a demo account long before real money is anywhere near the screen. Until next time, happy studying.